We all know a large chunk of our paycheck goes missing every 2 weeks, and in this video, we'll look at what's really happening and the control you have over it. Hey folks, quick disclaimer, I am not a CPA or a tax professional. This content is for educational purposes only. As always, if you have questions about your specific situation, I would suggest that you consult a finance or tax professional. We all pay taxes, at least most of us, but many people aren't aware of how the system really works and the actions you can take to make sure it's working for you, or at least not against you. In this video, we're going to focus on federal taxes for those of you that take home regular paychecks every couple of weeks. We're not going to dig into state and local taxes since that varies widely based on where you live. Federal taxes, generally speaking, are a pretty simple concept. You make some money and a portion of it goes to the government to pay for things like infrastructure, public services, security, and so on. The harsh reality is that taxes can be incredibly confusing, especially if you're new to the workforce. Let's jump in and make sense of this crazy financial world we live in. First, let's talk about your tax return. Everybody loves getting a check in April. I mean, what's not to love about getting money, right? In reality, the best tax return is no tax return. Getting a tax refund essentially means that you overpaid your taxes and the government now owes you money back. In an ideal world, you would only pay for the taxes that you owe instead of giving Uncle Sam an interest-free loan. So why doesn't that just happen? Well, the way you determine your final tax bill takes into account many different factors, like how much income you earned, your family situation, life events, and more. Most people rely on withholdings from their paycheck to cover their tax liability. The challenge is that you need to set up these withholdings in advance at the beginning of the year when you start your job, based on some assumptions to estimate what your tax bill will be at the end of the year. You may remember filling out a W-4 form when you started your job. This form asks you a few questions and you add some numbers, and those answers are used to estimate the taxes to withhold. Now, of course, life happens. Your income may change. You may get married, have a child, or any other number of scenarios that will end up affecting your tax status. In short, we're making our best guess at what our tax bills will be for the year, paying against those best guesses over the year, and then when the year is done, we go back and true it up based on what actually happened. And we call this filing our taxes. Now let's look at the types of taxes we pay and how they work. At the federal level, you will see 3 different taxes being deducted from your paycheck: income tax, which is usually the largest amount, Social Security tax, and Medicare. We'll dig into each one, but if you'd like to learn more about how your paycheck is broken down, check the description below for a link to a video digging in on that topic. Let's start with Social Security and Medicare, since these two are fairly simple. Social Security is a federal retirement program which pays income to retired individuals who have contributed into the program over their lifetime, which is precisely what you are doing here, paying into the program. The amount is easy to calculate. The deduction you pay is a flat 6.2% of your eligible income, which is your gross pay minus a few deductions, such as any amount paid for health and dental insurance. Social Security does have a cap, meaning you pay that 6.2% on the first $147,000 of income you make, or a total of $9,114 as of 2022. This number actually has been increasing over time and will continue to go up as years go on. If you earn more than that $147,000, then you will not need to pay any more than that. The exception to this is if you have income from 2 different sources that add up to more than $147K, which may result in you actually overpaying, in which case you'll take care of in your tax return and get the refund as a balance back. Medicare works in a similar way. You enjoy the same deductions as with Social Security, but instead of 6.2%, you pay a flat 1.45%. If you are a high earner, over 200K or 250K if you're married, then there is an additional tax of 0.9% on income above that threshold. Federal income tax is the biggie, at least for most people. Unlike Social Security and Medicare, the income tax is not a flat rate, but a tiered rate for different levels of income. You may have heard of federal tax brackets. These are the different tax rates you will be subject to based on your earnings. In 2022, the rates range from 10% to 37%, and they are applied at different income levels based on your filing status, that is, if you are single or married. For example, a single filer, let's call him John, earned $100,000 in taxable income. This will land him in the 24% tax bracket. Now that doesn't mean you're paying 24% on all $100,000 in earnings. You pay the lower rates for the tiered income levels. In this case, it would be 10% on $10,275, equaling $1,028. 12% on the next $31,500, totaling $3,780. 22% on the next $47,300, which would total $10,406, and then 24% on the remaining $9,109, totaling $2,206. So in this example, our taxpayer would be responsible for paying $17,420 total for federal income tax, which ends up being about 17% of his taxable income. You may have noticed I use the term taxable income. This is a very important concept to understand. Remember earlier when we talked about these deductions for health and dental insurance? Well, for federal income tax, you also get to deduct health and dental premiums along with vision insurance premiums, health or flexible savings accounts contributions, and traditional 401k contributions. All of these are reflected in the numbers on your W-2, that statement your employer sends you in the IRS at the end of the year reporting how much you earned. When it comes time to file your taxes, you will end up reducing that number even further to get to your taxable income. Uncle Sam allows us to either take a standard deduction each year to lower our taxable income or add up a bunch of smaller deductions, which is referred to as itemized deductions. The end result is that the dollar value of income you are taxed on will end up being considerably less than the gross amount you earn. So let's take our previous example and instead, let's say John earned $100,000 in gross income for the year. John also pays $200 per paycheck for health and dental benefits and contributes 10% to pay into his 401k account. That leaves $84,800 in earnings. If John takes the standard deduction, which is fairly common, and for 2022 it is $12,950, that would now leave him with $71,850 in taxable income out of the $100,000 he earned. This would result in a tax bill of $11,424, or 16% of his taxable income. Are you starting to see how all of this adds up? Knowing all of this ahead of time can save you thousands of dollars when you plan accordingly. So in our example from earlier, John owes $17,000 in taxes. Now, how does he actually pay it? Well, for most of us, this is why our take-home pay is less than what we make on paper, meaning some of the money we earn is withheld by your employer and sent to the government. If you are self-employed or receive income in a manner other than payroll, it will be up to you to pay estimated taxes directly to the government. Now that you know how the proverbial sausage is made, the real question becomes, how do you accurately estimate and plan for tax time? We'll go deeper into this topic in a separate video, but the short answer is you must first forecast your income for the year. That could be as simple as adding up all your paychecks. Once you have a good estimate of what your income will be, then you can use that information to look up your tax due either from the IRS tax tables or by entering it into an online income tax calculator. You will need to answer a few questions like if you're married or have children, which can net you additional deductions and credits, but at the end you will have an estimate for what you will owe. Compare this number to the amounts being withheld on your paycheck, and that should give you a good idea of where you'll land come tax time. In reality, we're just scratching the surface of this topic. I mean, there are people who dedicate their entire careers to this. The main takeaway here is that your tax bill is determined by your income, your personal situation, and the various adjustments that you potentially make to your income. Once you understand how this system works, you will be in a better position to make financial planning decisions to optimize your tax exposure. As always, thank you for joining me today, and if you have any questions, feel free to drop them in the comments below or let me know what other content you would like to see in the future.